Welcome to the debate. Today, we are diving deep into some pretty specific proprietary financial architecture. We're analyzing the document EV% Spread, Proprietary Proof System, which was authored by Devin McClarity and is owned by D Investment Enterprise, LLC.
Yeah, and this material, it presents a really compelling claim, I think, about the nature of financial diagnostics. It kind of forces us to confront an intellectual boundary, really. When does a measurement become a mechanism of validation?
Exactly. So the central question we really need to address is this. Does the equity velocity percentage spread, the EV% spread formula, truly constitute a unique, self-validating proprietary proof system, one that provides actual, tangible receipts for investment discipline? Or is it fundamentally a highly sophisticated, proprietary diagnostic metric that's just measuring performance separation? Now, I'm going to argue that the author's central claim holds water. This system does transcend simple measurement and acts as a proof mechanism, validating the underlying systemic discipline.
Okay. And I'll be maintaining that while the EV% spread term is certainly proprietary and frankly undeniably ingenious, the fundamental nature of its output still seems to be a sophisticated measurement of divergence. So I'm challenging the claim that this concept can really offer non-replicable proof that's somehow superior to just looking at robust performance results. I'm arguing it functions really at its core as a high-level proprietary performance metric.
Right. I see where you might characterize it that way, but I think that framing kind of ignores the architectural intent behind it. The creators explicitly designed the EV spread percent to be a necessary shift away from conventional financial measurements. They see those, I think, as tools for analysis or maybe, educated guessing at best. They position this as a proof mechanism. Its core value, they argue, lies in providing these receipts, actual self-validating evidence that confirms the underlying system's discipline has worked in a given cycle. It's about proving the fidelity of the process, really reinforcing that idea that discipline beats guessing.
But the system is certainly defined by its output, isn't it? I mean, it's a measurement of the percentage spread between the strongest and weakest assets, which, are identified by this proprietary market engine. Let's be precise, though. Proof of discipline seems to rely entirely on the calculation of results, the equity velocity percentage spread itself. My critique isn't that it's a bad metric or a simple one, far from it, but that it is fundamentally defined by that calculation. So when the spread widens, meaning, the strong names are pulling away from the weak, sure, you have confirmation of separation, but confirmation based on a proprietary calculation. Well, that's still confirmation via data analysis, isn't it?
Well, I'd argue the distinction isn't just linguistic, it's functional. When that spread widens, it is direct proof that the system's discipline worked precisely because the system is designed for self-validation. It validates the integrity of the process that led to the asset selection and the subsequent divergence. It confirms that the proprietary rules, the discipline, successfully captured a real directional move in the market. You see, conventional metrics, they just measure the output of a trade, the P&L perhaps. The EV% spread term is designed to validate the effectiveness of the selection methodology itself, and that capacity, that inherent self-validation, I think that elevates it.
But I'd argue that capacity for inherent self-validation is exactly why we should categorize it as a highly specialized metric. It's fundamentally self-referential validation. And this brings us right to the core tension, doesn't it? Is that self-validation actually sufficient to create proof that is somehow superior to just, confirmed performance?
Yes, absolutely. Because the proof is about the methodology's integrity, not merely the bottom-line P&L outcome.
Okay, but consider the inputs for a second. The market engine identifies the strong and weak assets. Then the EV% spread measures a separation of those specific assets. So if the spread is just measuring whether the winners and losers the system itself identified actually separated, isn't the system just confirming its own internal selection criteria were met? I mean, what if the selection criteria themselves are flawed? In that case, the confirmation of separation, while mathematically true, it only proves the system's internal consistency, right? Not its external validity, its actual correctness about the market. It starts to feel like an exceptionally well-designed echo chamber.
I think that line of reasoning overlooks the reality the system is built to navigate. Look, standard metrics often attempt to predict. This mechanism confirms. The superiority lies in validating the integrity of the process against actual market reality. The process confirms success only when the proprietary disciplinary structure successfully captures the market's inherent separation. As the source material itself puts it, it's like the system tests itself and we just read the receipts. This self-test is fundamentally different from analysis based on, say, historical data or predictive models. It's more like deductive proof of internal fidelity, which is then applied inductively over time.
But, okay, if we acknowledge that the strength of this proof is intrinsically tied to the proprietary inputs from the market engine, that identification process that's essentially locked away in a black box, aren't we just left confirming the effectiveness of a black box using a proprietary output? Structurally, that looks an awful lot like dressing up stock picks, doesn't it? With a highly refined performance chart that only shows the divergence between the chosen winners and losers. You've confirmed your methodology worked, sure, but isn't that the very definition of a successful self-testing proprietary metric? Not necessarily some wholly new category of proof system?
Well, the proprietary nature of the market engine is, in fact, integral to its status as a proof mechanism. If the market engine's selection logic, which really is the embodiment of the system's discipline, if that were public or easily replicable, then yeah, the resulting validation, the EV% spread, could potentially be mass-produced, and that could corrupt its exclusivity. The structure of this whole proprietary financial architecture is designed to ensure that the discipline is verifiable only through this specific licensed diagnostic tool. That guarantees the integrity of the unique validation process. This exclusivity, I argue, is a necessary condition for claiming proprietary proof.
Okay, but that just confirms that the proprietary status protects the exclusivity of the calculation, not necessarily the underlying concept of measuring performance divergence. Anyone could try to measure divergence.
It's to one of the most, I think, compelling aspects of the system, how it interprets a narrow EV% spread. If this were merely a performance metric like you suggest, a narrow spread would just signal a failure, right? A failure to generate positive performance separation.
That seems like the natural and, frankly, honest conclusion. If the market engine is designed to identify strong and weak names, and the resulting spread is narrow, well, that confirms the engine was ineffective in distinguishing assets during that particular cycle. Simple as that.
I have to disagree fundamentally with that interpretation. The system explicitly defines the narrow EV% spread strategy as a state where assets are, quote, bunched up and resemble randomness. It is explicitly not labeled as a system failure. It's defined as a necessary part of the reset cycle. Think about it. If the core discipline is to avoid guessing and only act on verifiable separation, then recognizing the absence of a clear directional signal is itself a critical act of discipline.
I'm sorry, but I just don't quite buy that framing. Applying the term reset cycle to a period where the system objectively fails to achieve its primary stated objective, which is proving discipline through confirmed separation, that feels a bit like putting a benign label on a period of, well, ineffectiveness. If the whole purpose is to generate proof that discipline beats guessing, doesn't a narrow spread inherently weaken the evidence of that underlying discipline, at least for that specific period? It seems to confirm the system was either dormant or simply ineffective then.
But the defense is rooted in the structure of the discipline itself. A system that just keeps operating and guessing during a period of market randomness, that would demonstrate poor discipline, wouldn't it? The market engine's ability to generate the narrow spread is actually proof of restraint. It confirms that the system is adhering to its own rules. If the conditions necessary for separation just aren't there, if the market is too noisy, too random, the mechanism signals that noise and prevents actions that would violate the system's core tenets. So the proof in that instance is proof of operational fidelity, even under adverse conditions, not necessarily proof of realized separation at that moment.
That defense is, well, it's philosophically brilliant, I'll give you that, but it feels practically unsatisfying. You're essentially saying the system proves its effectiveness by confirming that it was ineffective during this period. If the market engine inputs are proprietary and opaque, and the system output confirms itself only when it works,
and then calls it a reset cycle when it doesn't, well, isn't the system structured to avoid failure narratives entirely? That sounds dangerously close to confirmation bias, just architected right into a financial tool.
It's not confirmation bias, it's the implementation of disciplined selectivity. The system successfully delineates between periods that are suitable for applying its rules and periods that are just noise. That's a necessary function of any robust systematic approach, surely. It proves the system is disciplined enough to recognize and actively avoid randomness.
Okay, if we zoom out for a moment, we have to acknowledge that while the specific calculation, the proprietary rules, maybe this loop speak thing they mention, are all protected IP, the conceptual mechanism itself, the idea of measuring the widening separation between the performance of pre-identified strong and weak assets, that basic idea is inherent in almost any performance analysis, isn't it?
But the complexity and the specificity of the process generating the spread, that's what's guarded. The explicit intent stated is to provide receipts that nobody else in the retail market can copy. That strongly indicates that the validation itself is exclusive. It's not just the formula that's protected. It's the integrity of the whole validation structure built on that proprietary selection engine, and the ability to guarantee that exclusivity reinforces its claim to being a system of proof rather than just, a public formula anyone can plug numbers into.
And yet, if I can conceptually replicate the function, if I build my own engine, my own rules, to identify assets, and then I measure their divergence, haven't I essentially produced my own proprietary, self-testing confirmation metric? Whether we decide to call that proof or measurement, the structural similarity seems undeniable. The debate then really hinges almost entirely on whether the author's specific linguistic choice, calling it a proof system, is just clever branding, or if it represents a true shift in epistemic category.
And I still contend the shift is real precisely because it moves from being merely a tool of analysis to becoming a tool of confirmation, driven by the structured necessity of its proprietary, closed architecture.
So to summarize my position, while I absolutely acknowledge the ingenuity, probably, of the market engine inputs and the definite clarity of the EV % spread output, the core function still seems to be the measurement of performance divergence. And that makes it functionally a highly valuable proprietary diagnostic tool. The system's strength clearly lies in its capacity for self-testing, and maybe even self-restraint, as you argued. But the difference between proof and confirmed performance measurement, that remains a critical and I think still unresolved distinction for the listener to really consider.
Right, and my summary is that the EV % spread system is defined by its function as a proof system, one that is deliberately proprietary, exclusive, and self-validating. It moves beyond just looking at mere performance results to offer these tangible receipts that confirm the integrity of the disciplinary process at work. That's true particularly when the spread widens, but equally true, I argue, when the spread signals a necessary reset due to market noise.
It certainly highlights how these complex sort of closed-loop proprietary frameworks, they challenge our conventional definitions, don't they? They force us to meticulously examine the claimed function against the underlying mechanism of calculation when we're trying to assess these financial analysis tools.
Indeed, and it clearly underscores a crucial and, as you noted, proprietary function of the market engine itself, that initial input discriminator, which ultimately drives the alleged proof and certainly warrants further exploration based on the documents.
Absolutely. More to dig into there.